Hey traders, you're welcome back to the Forex Geek channel. In this video, we are going to talk about a strategy that can truly elevate your trading game, okay? And that is the ETF arbitrage strategy. All right, this powerful technique allows you to capitalize on price discrepancies between exchange traded funds, ETFs, and their underlying assets. So in this video, we'll just break down how the ETF arbitrage strategy works, how you can spot these opportunities, and how you can use them to your advantage. Before we dive in, make sure you hit that like button and subscribe to the channel so you don't miss out on more valuable trading strategies like this one. Let us get started. So what exactly is ETF arbitrage? Now, the concept behind it is pretty simple, right? In the world of financial markets, ETFs represent baskets of assets that are traded on an exchange, right? Just like individual stocks. Now, these ETFs can sometimes trade at a price that is slightly different from the value of the underlying assets in the ETF. So this is where arbitrage comes in, right? Arbitrage is the practice of buying an asset in one market where the price is low and selling it in another market where the price is higher. So in the case of ETFs, traders look for opportunities where the price of the ETF deviates from the actual value of the assets it represents, okay? So if these discrepancies are big enough, they present potential trading opportunities. Now, ETF arbitrage works by exploiting the price inefficiencies in the market. Traders who can spot these inefficiencies quickly can profit by buying or selling the ETF while also simultaneously buying or selling the underlying assets. Okay, the key here is recognizing these discrepancies before the market corrects them. Now, let us just break down how ETF arbitrage works in more detail. All right. So let us just assume that we have an ETF that tracks a certain index, maybe like the S&P 500. Now, the ETF holds a basket of stocks that make up that index, right? Ideally, the price of the ETF should align with the total value of those stocks, but sometimes due to supply and demand imbalances or market inefficiencies, the ETF trades at a premium or discount. Now, when the ETF price is higher than the value of the underlying assets, traders can buy the underlying assets or the stocks, right, and sell the ETF, capturing the difference when the price discrepancy closes. Now, similarly, if the ETF is trading at a discount to its underlying assets, traders can buy the ETF and short the underlying assets to lock in a risk-free profit. Now, the most common type of ETF arbitrage is called the intraday arbitrage, where traders exploit short-term price discrepancies. Okay, these opportunities may only last for a brief period, so the key is to act quickly, right? Now, how can you spot ETF arbitrage opportunities? First, you need to understand that these inefficiencies do not occur all the time, all right? And they can be tricky to catch. But with the right tools and knowledge, you can start to spot these opportunities more often. One way to spot ETF arbitrage opportunities is by using real-time data to track the prices of the ETF and its underlying assets. Now, many platforms allow you to monitor ETFs and their components in real time, so you can spot when these discrepancies occur. So pay close attention to the bid and ask prices of the ETF and its components, and look for situations where the price of the ETF diverges from its intrinsic value. Another method is to use automated tools and algorithms that can help you track price differences in real time. Many hedge funds and institutional traders use these types of algorithms, to automatically spot and act on arbitrage opportunities the moment they arise. Now, once you have identified a potential ETF arbitrage opportunity, the next step is deciding when to execute the trade. Okay, timing is crucial in ETF arbitrage because these price discrepancies can correct themselves very quickly. If you are too slow, the opportunity might disappear before you can even profit from it. So the best time to execute an ETF arbitrage trade is typically when you see a clear and significant discrepancy between the ETF and the underlying assets. Now, the discrepancy should be large enough to cover your transaction costs and leave room for profit. Let's say an ETF is trading at 0.5% premium to the underlying asset. You might decide that this is a good opportunity to short the ETF and buy the underlying assets at the same time, okay? After the market corrects the discrepancy, you can close the positions and lock in your profits, okay? To execute ETF arbitrage successfully, you need to have the right tools, right? Real-time market data is essential. So make sure you have access to a trading platform that provides this information instantly. Many professional traders use platforms like Bloomberg or Reuters for high-quality data feeds, okay? But even retail traders can access these tools through their brokers. In addition to real-time data, you also need a solid understanding of how the ETF and its underlying assets move in the market. So look for patterns in price movements and volume to identify potential opportunities. Now, once you get comfortable with this, you can start to use automated trading systems, or algorithms to streamline the process. Now, there are also several third-party services that specialize in arbitrage opportunities, right? Some of these services will scan markets for you and alert you when a potential opportunity arises, right? Saving you time and effort. Now, as with any strategy, any trading strategy out there, ETF arbitrage is not without its risks, okay? In as much as, it has its, potentials, but it is not without its risks, okay? There are risks to this strategy. There are risks to it, okay? While it can be a low-risk strategy, if done correctly, right, there are still potential pitfalls. And one of the main risks in ETF arbitrage is the execution risk. If the prices of the ETF and its underlying assets diverge too much or the discrepancy closes too quickly, you might not be able to execute your trades in time to capture the profit. All right. Now, we also have other risks like the liquidity risk. Right. We have the liquidity risk. If the ETF or its underlying assets don't have, enough liquidity, it may be difficult to get in and out of trades quickly enough to take advantage of the price differences. Also, we have the, transaction cost. You have to have the cost considerations, right? If the discrepancy is small and the transaction costs are too high, the arbitrage opportunity might not be worth pursuing. There are also risks of, regulation, like regulatory risks, there are counterparty risks and operational risks as well, okay? So you have to be aware of all these risks that are involved in the arbitrage landscape, okay? Now, to sum it up, the ETF arbitrage strategy is a powerful technique that allows traders to profit from price discrepancies between ETFs and their underlying assets. While it is not always easy to spot these opportunities, with the right tools and knowledge, you can begin to recognize them and take advantage of the inefficiencies in the market. If you found this video helpful, make sure to hit the like button and subscribe to the channel for more strategies, tips, and market insights. Thank you for watching and happy trading. Keep practicing, keep learning, and I look forward to seeing you in the next video.